What's the number one thing that keeps people from making smart investments? Emotions. Whether we want to admit it or not, money can be an extremely sensitive topic for people. It's something that connects us to our lifestyles and status in society, and so we put a lot of value on it. That's why most people don't like talking about money, and why so many people make bad choices when investing. Nothing can be more emotional than gaining or losing money. And the problem is that if we listen to our emotions, we will always make the wrong choices when we're investing. Say a crypto like Bitcoin starts going down. It's easy to get worried and pull out our investments out of that coin. Then when Bitcoin starts going up again, we get excited and start investing our money back into it again. The problem here is that our emotions just cause us to lose money on our investment. We just sold our Bitcoin when we were at a lower value and bought back in at a higher price. Emotions and investing just don't mix. And that's why we need to have investment strategies that help keep our emotions out of the equation. And one of my favorite strategies is DCA, or dollar cost averaging. Not only does this method help take those emotions out of investing, but it can also help reduce the stress of investing. It can save you time, and it's a skill that's incredibly useful for both new and experienced investors. But first, if you're new here, my name's Ben. I've made over 6 figures trading crypto. I'm on a journey to 10K a month of passive income, and I want you to join me on this journey. Let's go. Now, let's say that I'm new to investing and I have $500 that I want to invest into crypto XYZ. Dollar cost averaging means that instead of investing my $500 all at once, I will divide my money into equal amounts and invest those smaller amounts on a regular basis. That's basically all this strategy is. One way I could do this is by investing $50 into XYZ crypto every Wednesday for the next 10 weeks. By creating a set schedule of when to invest and sticking with it, I can keep my emotions from influencing my decisions. It doesn't matter if XYZ crypto is up or down, I will invest that $50 at the time I said I was going to do it. But there's a question most people have about dollar cost averaging when they first hear about it. Why not just invest the $500 all at once? Wouldn't that make it easier and even less stressful? But there's a reason why dollar cost averaging works. And after hearing about it, you'll soon see the benefits of using this strategy. Here's a question. Do you know which cryptocurrencies are going up or down tomorrow? What about the next week or the next 3 months? No one really knows. Right as we speak, experts are giving their wildly different predictions as to which direction cryptocurrencies are going to move. And really, these are just their educated guesses. If there really wasn't a financial expert who could reliably tell us if any investment was going to go up or down, they'd become the single richest person in the world. Even cryptos that reliably trend upwards like Bitcoin and Ethereum fluctuate unpredictably. Going back to our example, let's say we did our research and know that XYZ is a crypto that does reliably trend upwards. But if we do invest our $500 all at once, we don't know if XYZ is going to keep going up or if it's going to take a huge dip the next day. You can do as much research as you want, but there's no way to say for sure what's going to happen. This is what makes dollar cost averaging a much safer investment strategy than the all-at-once method. By taking our money and investing $50 each week, we will sometimes buy more XYZ coins when the price goes down and sometimes get less XYZ coins when the price goes up. And ideally, all these up and downs will average out to the typical growth of this crypto. By using dollar cost averaging, we're able to better predict what our actual return is going to be because we're investing in the average growth of XYZ crypto instead of just that unpredictable moment. And this is what makes dollar cost averaging such a great strategy for new and casual investors. It makes it easier to predict the return of our investments and takes a lot of the stress and worry out of investing. You could use dollar cost averaging to grow a college fund, for example, without having to always be keeping an eye on changes on your investment. It's safe, it's easy, and you could even set up recurring payments on some platforms to give yourself even more peace of mind. But for people who want to take their investing to the next level, dollar cost averaging is a must-know strategy for becoming an expert investor. It's great for getting into the habit of investing regularly, and it takes your emotions out of the game. But that's just the first step. Now we can take this principle and turn it into Warren Buffett level of investing. There's a variation of dollar cost averaging that I like to call value investing. Imagine for a moment that instead of buying crypto investments, we are buying toilet paper. Let's say that every day the cost of toilet paper will randomly go up and down. If we wanted to have a consistent amount of toilet paper for our homes, then dollar cost averaging would be a great strategy to use. You go to the store every week, spend the same amount of money, and over time get toilet paper based on the average cost of the product. It's simple, reliable, and you don't get caught in a bad deal. But what if we made a minor adjustment to our strategy to improve our paper buying habits? What if we spend less money on toilet paper when the price for it goes up and more money when the price of toilet paper goes down. Over time, we would end up with more toilet paper while still spending the same amount of money. So this is the principle behind value investing. Going one more time to our hypothetical investment scenario, if I put $50 every week in XYZ crypto, I would sometimes be able to buy more XYZ coins when the prices are lower. So if I can see that this week where XYZ is cheaper, I know XYZ crypto is a reliable history of growth, then this could be a great opportunity to put in more than $50. If the price dips down, I could put in $75 into this crypto to buy it at a bargain. Then when the price spikes up, I can put in $25 into XYZ, and since I'll be getting less coins anyways because the price is a lot higher. If I use value investing effectively, I will end up with more XYZ coins than I would just using vanilla dollar cost averaging. It's the same $500, just invested a little smarter. Even though this strategy is extremely simple sounding, it can be different to remember when we're actually investing. Take the 2008 market crash as an example. The market crashed, even some of the top investors in the industry got scared and pulled out of their investments, afraid of how low the market would drop. This strategy might have helped some people lose less than they could have, but almost no one took advantage of the dropping market prices to buy more market shares. However, one notable example of someone who did take advantage of the market crash was Warren Buffett. While everyone was pulling their investments out of the market, Warren Buffett used the value investing strategy and doubled down on his investments. Warren Buffett put extra investments into companies that had falling market prices during the crash, but otherwise had a history of strong stocks. After the 2008 crash that took away so much from people, Warren Buffett managed to make a profit of $10 billion by holding on to this very simple strategy. We also saw investors using similar strategies during the recent pandemic, using the market crash in 2020 as an opportunity to invest in stocks and crypto for unbelievably low prices. Dollar cost averaging and value investing is the reason so many people make a profit in investing during the pandemic. Instead of following the emotions of fear and concern, the people who win in the stock market and crypto market are the ones who put those emotions aside to follow the basic strategies that are proven to work. And this is why I wanted to talk to you about this. Dollar cost averaging is such a simple and flexible approach that can benefit any investor and make investing in crypto a lot more predictable. But because it's so simple, it can be easy to forget when things get tough. Just remember to put your emotions and gut reactions to the side. Think about the situation, analyze it, and use numbers and strategies to find the best actions to take when investing. If you've made it this far, then you probably found this video helpful. In that case, you might want to also check out the video on my 6 biggest trading secrets, where I go in depth about the strategies I've used to be successful investing and trading in crypto. Thank you so much for watching, and remember, as always, keep it in the green.